This is Chapter 17, Video 1. Let's launch. All right, so the learning objectives for this video is going to be that we're going to describe the objectives of the FASB ASC Topic 740 income taxes and the income tax provision process. The objectives of accounting for income tax provisions. Okay, so a little background about me. When I worked at KPMG, what had happened, I worked in the global mobility services. So I did individual tax returns for internationals. And kind of came down the pipe at one point where they said, hey, look, we need somebody who's a senior who has a background in accounting. We don't have enough personnel. We don't want to hire somebody to specifically do this because we only need this on like 2 or 3 clients. And we want to bring this person in to give them kind of an opportunity to do this. I mean, it was, for me, it was a great opportunity because, you know, to do income tax provisions for audit statements. At that time, I didn't have a whole lot of audit knowledge. And so this was a great opportunity for me to get some exposure. I mean, I worked, I can't tell you the name of the clients, obviously, but the clients I did work on were big name clients. I mean, they're household name clients. And so that was actually pretty cool. So the income tax provision includes the current year taxes payable or refundable, and then any changes in future income tax refundable as part of timing differences and all that. And the way we did this at KPMG is that we would build these massive spreadsheets. And we would say, okay, state and local taxes, these are the provisions that these guys have to worry about. Federal taxes, these are some of the provisions that these guys have to worry about. My job was to build the sheets, and then the senior manager on the case, who actually was a part-timer, she had had a family, had kids, decided that she didn't want to work much. They loved her a lot, so they wanted to keep her. And so they said, look, we're going to cut a deal with you, and we're going to give you this opportunity to come work for us on a part-time basis. And she really enjoyed it. So it was good. It was really good for everybody involved. It says here that a company records these future income tax payments or on the balance sheet as either deferred tax liability or deferred tax assets. We call them DTAs, DTLs in the industry. So, again, DTL is the future taxes payable, and then DTA is future taxes refundable. And we'll talk about each of those. So the objective of AC 740. AC 740 is basically, it applies only to the income tax level by federal governments, state and local governments, and then, of course, foreign governments. Now, the big thing about this is all about what to report on the financial statement, not in the tax return. This has, I mean, obviously it's income tax, so it does affect, the IRS has an effect on it, but the IRS doesn't get this. This is not the IRS's thing. So when you do the compliance on this, you have to think a little bit more like financial accounting as opposed to tax accounting. However, tax accounting is going to affect this number, but the actual reporting of it gets reported on the balance sheets and everything of that nature. So companies report non-income taxes as expenses above the line or in the line of income before taxes. And then ASC 740 lists 2 objectives. Okay. And the 2 objectives are to recognize the current amount of taxes payable or refundable in the current year. And then also to recognize the DTA, DTL for the expected future tax consequences in the future. Because if you think about it, you're an investor. You want to find out if you want to do some investments in this company. They have a whole bunch of losses and you're wondering what the benefits that they're going to get off of that. That's important. But you also want to find out, do they have any hidden tax liabilities that I don't know about? That's why this is important. That's why you have to get this done and you have to do it right. All right, both objectives relate to reporting a company's income tax amounts on the balance sheet, not the income statement. And the ASC 740 approach to computing the tax provisions is often referred to as the asset liability approach. And that's true. When you report the actual taxes paid, that's going to go on to the actual income statement. But the actual DTA, DTL all goes onto the balance sheet. And so that's why they're saying the assets and liability approach. So book to tax difference can occur for several reasons. And again, this really focuses on those book to tax differences. What are some potential benefits and rules that could end up happening that a company can take advantage of? And the different accounting methods that are used in computation, straight line depreciation for book, accelerated for tax, There are also some other book to tax rules that are different. Not all book income is taxable. Not all book deductions reduce taxable income, and not all tax deductions reduce book income. So all these things have to be taken into account when calculating DTA DTLs. Timing when income and deductions are reported on the two statements may differ. Different entities may appear on two different statements. I'm not going to talk too much about this. We'll get more into this a little bit later on. But again, this is part of the ASC 740. Sorry. So to compute the DTA DTL, a company calculates the future tax effects attributable to temporary differences and tax carry forwards. So the temporary differences, and you notice there I'll say temporary. We don't care about permanent. Okay, so we don't carry DTA DTLs on permanent. They're all temporary. So that's why it's important when we went back into corporate operations and we talked about this, we said, look, these are temporary, these are permanent. You need to be able to identify those for those reasons because it does affect the financial statement. Best practice is to keep both books and tax balance sheets and compute the range. And it's kind of funny because they say both book and tax balance sheets. Most of the time when you're reporting, and actually not most of the time, it should be all the time. And this actually is a pet peeve of mine. I know there's some firms that are out there that actually, when they do the balance sheet on Schedule L on their corporations, they report the tax balance sheet. And that blows my mind. I don't understand why they do that. Well, actually, I do know why they do it, but I'm not going to say why. You need to report book because it says balance sheet per books. But that doesn't mean that you don't calculate what a balance sheet is for tax. You will calculate the balance sheet for tax. You're not going to report to the IRS. IRS doesn't care. But there you're going to need this when you do the DTA DTL when you're actually figuring a lot of this stuff out. Okay, so steps in determining the provision. You're going to adjust pre-tax income for permanent differences. Obviously, those are gone. Identify all temporary differences and carry forwards. And then you're going to calculate the current income tax expense or benefit and then recognize deferred taxes, assets, and liabilities. That's going to be kind of the process that you're going to go over, and that we'll discuss in greater detail. Evaluate the need for a valuation allowance for DTAs. Calculate the deferred to income tax expense or benefit, and then evaluate the need for an uncertain tax benefit reserve. These are things that you're going to be taking, and again, because we're talking financial accounting, we're not talking IRS, there's a lot of judgment that goes into this. And so you want to make sure that you're making correct judgments. Again, as a staff, you're probably not going to be making those judgments to begin with, but you will definitely be making the judgments as you prepare the rest of the as you go forward in your career. Income tax process, provision process is going to be compute the two components of the income tax provision. You're going to calculate the current and then the deferred and combine the two components to produce a total income tax provision. So there's a current portion and a deferred portion. All right. Formula, income tax provision equals current income tax expense plus or minus deferred income tax expense, for the benefit. Okay. And that's how you get it for doing this. All right, so that's all I got to say about this. A real short video for an introduction. We've got 5 videos in chapter 17, so you want to make sure that, get the coffee ready. I will see you around. I'm looking forward to seeing you in the next class, and thank you very much.